Hello, traders. Trading sentiment was subdued during the Asian session. In China, there was a surge in new coronavirus cases. It delivered a severe blow to investor confidence that had already been hurt by other fundamental factors. For instance, market participants are extremely worried about the crisis in Ukraine, the first rate hike by the Fed in 3 years, and a new wave of tensions between China and the United States. Stock markets in the Asia-Pacific region declined on Tuesday, excluding the Nikkei, and let's discuss what happened in the Asian session. The US dollar may be quite volatile as the Fed begins its two-day monetary policy meeting today. According to the CME Group, 98% of the surveyed analysts expect a rate increase. Apart from that, traders are also interested in the Fed's dot plot that records each projection for the central bank's key short-term interest rate. The dots are expected to be mostly located around 4 or 5 hikes over the year compared to the 3 dots placed at the beginning of the year. News about the Russia-Ukraine conflict also affects the trajectory of the US currency. Now market sentiment is positive amid hopes for positive results of the negotiations. However, there is a risk of a subdued surge in volatility if the parties hold talks or something unexpected happens during the negotiations. On Monday, the US dollar managed to consolidate at 99 points. In the Asian session, it weakened slightly due to a rise in the euro and the pound sterling. However, its decline will not impact the prevailing trend. The greenback is sure to climb as traders are pricing in monetary policy tightening. The target levels remain the same. First, the US dollar needs to approach the early high of 99.41. After that, it should break through 99.97 and then the psychologically important level of 100 points. The US dollar is still gaining momentum versus the yen. The main reason for this is the different approaches of the Fed and the Bank of Japan to monetary policy. Japan's regulator is not ready to tighten monetary policy. It will hold a meeting on Friday, and it's widely expected to maintain an ultra-soft stance aimed at stimulating the economy and achieving the 2% inflation target. Earlier, the Bank of Japan governor hinted that the regulator may taper some pandemic stimulus programs to slow down rising inflation. To do so, the central bank needs to wait for the growth of salaries. And the dollar-yen pair is moving to the range of 119.53 and 119.90. After that, the pair may perform a downward reversal because of the stock market's woes. There is a high probability of a decline in the stocks in the middle term after the rate hike by the Fed. The trajectory of the pair will depend on how quickly the equity market will fall following the Fed meeting and the strengthening of the US dollar. Analysts reckon that the bearish sentiment in the stock market will have a greater impact on the pair as the US dollar looks overbought. This is why the dollar-yen pair is likely to resume a downward movement. The Aussie is also facing bearish pressure. Today, the Reserve Bank of Australia took a cautious approach to further monetary policy tightening, which facilitated the downward movement of the Australian currency. The Reserve Bank of Australia meeting minutes have revealed that the conflict in Ukraine brings uncertainty to the market, so the central bank will remain patient and keep monitoring various factors affecting inflation in the country. Policymakers are now unwilling to raise the key rate until inflation holds steadily at the target range of 2 or 3%. Judging by the current movements, our forecast for the Aussie was correct. Yesterday, analysts predicted a rapid drop. On a Monday, the Aussie lost 100 pips. During today's Asian session, it continued to decline, and the next downside target is located at 0.7065 due to the negative fundamental factors. The AUD/USD pair may remain below the indicated level for several days. And that's all for now. Keep abreast of the latest market news with the InstaForex TV channel. Feel free to leave your feedback and see you soon.